Himanshu, hi, morning. Good to chat with you. I want to firstly talk about this EBITDA margin decline that you've seen. What would you attribute this to? And also the newly integrated acquisitions, currently operating at lower EBITDA margins than the standalone business. What's the timeline to bring their margins in line with Polymed's 25 to 27% guidance?
Yeah, good morning. I think if you look at the margins in the current quarter, standalone basis, EBITDA was around close to 27%, 26.8%. So the margins were not that bad. And I think comparatively, if you see from quarter two, they were very steady. Quarter two was 26.7. So we are very much in line with margins, which we had actually projected in the beginning of the year. The range was 25 to 27%. Now we look at the console level, yes, the margins have gone down to around 24.2% because the subsidiaries, the companies we acquired, of course, operate on a lower EBITDA margin. And we will see that, margin expansion happening in this current, calendar year as we see the synergies kicking in. So, but if you see the revenue growth, has been very steady. I think as we had projected earlier, H1 to H2, we will see a 20% growth. Of course, exports have been weak. But overall, we see revenue growth has been close to around 10%. And I think once we end the year, it will be close to 14, 15% of revenue growth over last year. So I think we are probably okay right now, but yes, exports were slightly slower.
Okay. Himanshu, give us a perspective. What was the impact of US tariffs on India for you? Because US is a large market for you. Give us that perspective. What does this resolution also do in terms of an impact? Does it suddenly accelerate some pent-up demand? How does it play out? Give us a sense.
So I think this is a great deal for India, I would say, because we were getting a lot of business was getting lost to nearby countries like Vietnam, Malaysia, and Thailand. And I think now with this change in tariff, I think many companies which had gone out of India, or they were not sourcing from India, they will come back to India. We had also a few contracts, which will become more operational in the current financial, in the let's say current or next quarter, I would say from this quarter to next quarter. And I think we will see our US revenue also picking up, as time progresses. Though we have guided that US revenue over next 2-3 years will be close to around, now $15 million to $20 million, and also the subsidiaries we have acquired, we're also planning to, start pushing business through them to the US market. So overall, US seems to be a very positive, for us right now.
And you suggested that margins compressed at least at a console level due to acquisitions you've made. Give us a sense of when does that unwind happen? Does it happen pretty much immediately? Would Q4 be that quarter where it'll unwind, or will it happen over a period of time? How quickly can you unwind that? And your 25 to 27% EBITDA margin guidance, is it on standalone? Is it on console? Give us a sense of that as well.
So the guidance, first I'll go to the EBITDA guidance. That's also on consolidated basis, basically. So I think currently we are around 24.2 for the quarter three. If you look at that number, but if you look at 9 months number, it is still around 25%, roughly in that range. If you look at the 9 months EBITDA margin, and I think we are going to be between that range for the full FY26. And we're looking at the consolidation, and the expectations are that from quarter 2 to quarter 3 of next year, we will see margin improvement because there are a lot of regulatory things which we have to fulfill. And when we have to do some change of suppliers, change of location of manufacturing. So all those will start kicking in, after a couple of quarters, because medical devices are heavily regulated industry. So it takes time to build that competence internally and change the supply chain and suppliers. So, but we are very confident of the product lines because one is in cardiology segment, one is in orthopedic segment. And both these segments are I think, pretty, mature actually globally. And we see a lot of traction for Polymed there.
Okay. If you could just quantify this, Himanshu, just trying to understand, while you've seen good growth from Europe, wondering if 25% is sustainable. And now with the India-U.S. trade deal in place, what kind of, revenue recognition or margin recognition do you foresee?
See, definitely definitely Europe margins, export margins are better for sure, and US margins will be better for sure compared to what we do in India and rest of the world. So I think so we have not given guidance, but of course we are very sure that next financial year will come back to 20% growth levels. Already, I think the plans are very clear. The markets are again opening up. US will open up more, and also Europe is stabilizing for us. So I think in terms of margin, I think we will still be north of 25%. I think we're in the next financial year.
The growth, Himanshu, for FY26, the growth guidance was, you suggested around 14-15% top line. FY27, does it make you materially more bullish with regard to growth, both US, Europe firing for you likely FY27? 20% was your guidance. Would you up that?
See, currently, we have not fully finalized the numbers for the moment. Maybe we'll have a better, visibility after Q4. But what I can see right now, we will be actually doing more than 20% growth in FY27 for sure.
Okay. Himanshu, thank you so much for joining us, giving us that perspective. 20% growth for sure, FY27. Viewers, that's really the take, 15% for FY26, despite all of the headwinds. That's what's playing out on Polymedicure. But what we'll do is slip into a very short break. We'll come back with more. Stay with us.